What is up, guys? D Chantilly here, and today we're going to be taking a look at Chegg, ticker symbol CHGG. As of August 3rd, 2020, has a stock price of $85.93 a share, giving it a valuation of $10.447 billion. It's in the consumer discretionary sector, and it is considered a mid-cap growth stock. Chegg is one of the companies at the forefront of an industry ripe for disruption, and that's the education industry. The education industry has been able to withstand what other industries like newspapers and retail really couldn't, and that's technology. And I don't think that can happen much longer, especially when you take into consideration that we are currently in the middle of an outbreak where students aren't likely to be back on campus, meaning they're going to be looking to the internet for resources. And so when you look at Chegg, they can offer cheaper solutions to things like textbooks and education. And let's take a look out to the global education market. It's currently estimated to be worth about $6.5 trillion in 2020, and that's expected to grow to $10 trillion by 2030. 55% of that is expected to be K through 12, and 25% of that is expected to be post-secondary education, also known as college or university if you are Canadian. Those two components make up about 80% of the $10 trillion or $8 trillion worth, and that just so happens to be where Chegg's main demographic is. The company states that their current market opportunity includes 36 million US university and high school students, 18 million Canadian, Australian, and British secondary and tertiary students, also known as college students, totaling 54 million students. And when you look towards their potential market opportunity, they see they can add 48 million students from English language instruction as a medium, tertiary students outside of the United States, Canada, Australia, and UK. Chegg also broke down where their services are most used, and 61% of it came from none other than STEM, which is no surprise. And STEM stands for science, technology, engineering, and mathematics, probably the toughest field to study, and this is coming from a business major. And so don't attack me. I know the STEM is a very broad title because it's science, technology, engineering, and mathematics. Very broad. But I've looked at some of those engineering textbooks and had not the slightest clue of what was actually going on. But anyway, back to topic. STEM is a fast-growing segment. According to the United States Bureau of Labor Statistics, they forecast overall employment in the economy to grow by 7.4% between 2016 and 2026, while jobs in STEM fields are expected to grow by 10.8%. According to the U.S. Department of Commerce, college-educated STEM job holders earn between 29% and 39% more per hour than non-STEM employees with the equivalent educational attainment. And so as you can see, the STEM jobs are expected to grow faster than the rest, and they're going to be some of the more higher paying jobs out there. And the reason I think people would choose Chegg is because of their services. And when you look at what's going on, people in college are obviously going to be targeting these jobs, but kids in high school are also going to be gearing up for these jobs because, at least from an anecdotal perspective, high schools are beginning to push kids into those STEM fields, and they're trying to bring those kids up to take interest in those specific fields. And so I don't only see college students as a big opportunity, but high school students as well for Chegg. And the reason I think people would choose Chegg is because the current conditions we're in, on top of their services usually being cheaper than an alternative. You can go out, find a tutor, go to these physical locations, but right now you don't really feel comfortable doing that. And so you can be tutored from the comfort of your house, and that's something that I think is going to have lasting effects on people, because if I can get tutored from my house, why would I go out, leave my house, go to a certain place, have to pick my kid up at a certain time, or drive back at a certain time, when I can do it all from the comfort of my house and my laptop? So I think it's very sticky that you can be tutored from your house, and it's going to keep people coming back. And on your screen are just some of the prices for Chegg services according to architect.org. In the first section is what they call simple services, and Chegg also offers tutoring, as we were just talking about. And that's going to be a big thing for them, because especially this quarter, because most kids won't be on campus this first semester and may need help, or kids won't be in their high schools for the first half of the year and don't want to fall behind, or their parents don't want them falling behind because maybe the school doesn't offer any tutoring or doesn't offer adequate tutoring. And just to name some of the sites that Chegg owns that we may have used in the past, they include Mathway, EasyBib, Chegg Writer, which is obviously belongs to Chegg, it's quite literally in the name. And they recently acquired a company called Thinkful, a really cool site where you can be taught skills related to the tech industry. And since we're talking about services, let's talk about service revenue, which brought in $126 million for the second quarter, up 57% year over year, making up 82% of total revenue. Heyo, I bet you didn't think you'd see me in the video today, and if you thought that, you were wrong, but that's okay. And so anyway, I ran these numbers on Chegg multiple times for my projections to see what I can come up with. I had to do it a couple of times because I felt like some were too aggressive, some were just too conservative, and so I tried to find a happy medium. And with that, I turned all of this into an Excel sheet, but the Excel sheet was not visually appeasing to look at. And so, me being the fantastic, hardworking person I am, I went the extra mile. I hit my knuckles on the desk. I'm just, ow. Me being the fantastic, hardworking person I am, I turned it into this beauty just for you. And so I went back to 2017 and collected data to see if I can identify a growth trajectory and try to value this company and get an idea of what revenue could look like going down the road and assign a valuation to the company as we go. And so for 2020, my projections were a bit aggressive because I took the high end of the company's expectations for full year 2020, and those expectations were still much higher than Wall Street was expecting. Wall Street is expecting $554.05 million for the full year and $1.20 per share earning, giving the company about a 26% margin. And for my forward projections, I just gave the company a 26% margin for every year. Obviously, that won't be the case, but for this kind of investment, we don't know what they'll be buying, what kind of things they'll be investing in, where there'll be, other capital allocation decisions. So I just kept what Wall Street gave them this year at 26% for every year going forward. And for my outlook, again, I gave them the 26% margin, and 26% margin on $615 million in revenue came out to $159.9 million in net income, or $1.32 a share. The company traded about 23.24 times sales heading into earnings, and I wanted to cut that down to about 20 for the next 2 years because, yes, it is a fast-growing stock and it's deserving of a high PE as of right now, but 23 just seems like a whole lot. And so for 2020, I gave the company a valuation of $12.3 billion, or $101.16 a share, meaning it'll trade a very expensive 76.92 times earnings. But with companies like this, meaning very fast growers, I learned the hard way not to focus so much on price to earnings, because price to earnings matters much more as the company matures. And for my forward calculations, I became much more conservative. I took the percentage changes over the last 3 years, taking the high end of the estimates in 2020, and used the averages of that to predict my growth. So services revenue came in at about 39%, required materials came in at about 20%, EBITDA, I did things a little differently. I used the average of 60% for 2021 and slowed that down to 52% for 2022. For 2021, services revenue came in at $695 million, required materials came in at $138 million, EBITDA, or earnings before interest, taxes, depreciation, and amortization, came in at $312 million, and net income of about $216.58 million. I gave the company a price to sales of 20 again, meaning the company will be valued at $16.66 billion, or $137.03 a share. And for 2020, according to my projections, this will be the company's first billion-dollar year in terms of revenue. Service revenue comes in at $966.05 million. Required materials comes in at $165.6 million, totaling $1,131,650,000. There's still a thing called other income, but I focused on their main sources of income to come up with these predictions because other income is just inconsistent and we don't really know what that is. And so EBITDA comes in at $474.24 million, net income of $294,229,000, and I dropped the price to sales for 2022, giving it 17 times, meaning the company will have a valuation of about $19.2 billion, or $158.23 a share. Also, the PE ratio drops about 15% to, a still expensive according to the metric itself, 65.38 times earnings. And so let me know what you guys think about Chegg down in the comment section below. Do you think my expectations are too conservative? Do you think this thing can skyrocket over the next couple of years? Do you think I'm being a bit aggressive? I don't think I'm being a bit aggressive. I think I took more of the conservative approach to this stock as I do with most of my investments. So let me know what you guys think down in the comment section below. Are you excited about Chegg? Do you want me to do their competitors like K through 12? And there's other competitors on the market, in the stock market, that you can invest in. Let me know if you want me to discuss those. See you in the comment section.